Everybody, Brock VandenBerg, president of TaliMar Financial and TaliMar Income Fund I. Today, we're going to go over the March numbers, talk a little about what we're seeing in April. We're going to cover a lot of topics, including what the returns of the fund were, how did we get to those returns, talk about loans that we originated, talk about our servicing portfolio, and then talk about some really cool articles that I came across in just the last couple of weeks. Again, I apologize. I was at the Jurassi's conference, which is a big conference for mortgage fund managers, and I actually had the opportunity to speak on one of the panels. So I'll go into that as well. So let's go hit the numbers. So again, I just want to say thank you very much for listening in. Super excited to talk about some of the information we have to share, again, about returns, what we anticipate going into the end of April. And what we should see going into almost now obviously the second quarter of 2023. So let's first go into our notable successes for the month. So for the month of March, we returned a net 8.74% annualized return. Now, some of you may say, well, Brock, that you had almost a 9.7% return in February, and that is true. It's just the way the calculations are made. It's on a daily calculation because February had 28 days and it earned effectively the same amount of dollar return. It looks like it's a higher at the percentage return versus March that has 31 days. So I got that question a lot. Well, Brock, why was it up at 9.7%? I think at the end of the day, if you were to use just a straight 30-day month, we're really close to that 8.9, almost 9% annualized return every month. So the second point, no late payments or loan defaults. I'm really excited about this. We really focus on servicing our portfolio, really look for problematic loans and take corrective action very quickly. So no late payments, no loan defaults. We had a great March for raising capital. In fact, we raised a little over 3.3 million. We did it two ways. Number one, obviously a lot of people worried about the volatility in the market. They're looking for some more surety, looking for consistent monthly income. So we saw some new investor capital coming from there. We also had a lot of trust deeds pay off. So a lot of that trust deed capital has been slowly moving into the mortgage fund. So really excited about the capital raise, really gaining some momentum. Again, our goal for the end of the year is at 75 million. Currently, we're a little over 40 million right now. So we got a ways to go, but there is a lot of money coming into the fund. We opened 6 new accounts. That means 6 new investors came into the fund. We're at roughly 100. I think we're just shy of 145 investors in the fund. I think we'll top 150 by the end of this month. And then we returned a record 264,900 to investors this month. Really excited about that. We're seeing these returns really jump as we bring new investor capital in. Loan origination. So these are new loans that we funded. Activity was on the lower end. We only funded 4 loans for 4.7 million, but you can tell they're bigger size loans. So we're doing fewer loans. They just happen to be larger loans. The nice thing about it as a fund manager, when you do that, is it doesn't take as much resources to be funding those kinds of when you funding a larger amount of loans. So you don't have to have a huge staff to be doing, let's say, 30 loans to get to 4.7 million. Our goal between about 5 to 7 million. What's really holding us back right now, though, is just the amount of investor capital we have to lend out. We're really we're capping or we're stuck at that 40 million mark. That's why we're very tenacious on bringing in new capital to the mortgage fund. Average note rates at 10.45%. I mean, this is over 2 percentage points higher than what we were about this time last year. We're underwriting to most loans to about 10.5. I think we closed one loan at 11%. So with the Fed raising rates, we're able to increase the interest rates that we're charging our borrowers. Average loan to value ratio was a little higher than 65%, which is our target at 67.28%, primarily because we had some fix and flip loans that we funded So we're typically around 70% loan to value on those SFRs. Average duration 12 months. As I like it, short-term loans in and out. Don't take undue risk, market risk. Don't take undue interest rate risk right now. We have been, though, really looking at writing 24-month loans that have an adjustable rate component after month 12. So essentially gets you to that month 12 mark, and then if rates have gone up, you can readjust that loan to the new rate. And all first position loans. That's all we fund here in the mortgage fund. So loan origination, here's a good example of what we have been funding. As you can tell, really July, about this time frame, is when interest rates really started to increase. So we saw deal volume go down. It's just transaction volume in the market had gone down. And then really about that October, November time frame, we saw those loans started coming back in. And it takes, I always say, it takes about 30 days is the kind of the life cycle of when a loan comes in as loan origination to when we physically close it. So you can tell right in December, as we were bringing those loans in October and November, started all closing in December. So we've had a pretty steady flow of loan volume coming in. And when I say steady for the amount of capital that we have. I could be doubling the amount of loans that we would be funding if just we had more capital available to us. So let's talk about loan origination in terms of loan type. Fix and flip loans are big and back and bad right now. People are out there buying single family homes and they're renovating and selling them for a profit, and they're doing very well on the flips, especially flips that they had bought in the October, I'd say in the October-November timeframe, where there wasn't a lot of activity. They could negotiate a little better prices with sellers. So they were able to take those houses down, renovate them, and now they're coming to the market to be sold. So we're seeing a lot of fix and flip loans, and then bridge loans. Bridge loans, again, are loans that borrower either needs to close quickly because their existing lender couldn't close quick enough, or they have to refinance an existing loan that is maturing. We're seeing a lot of that, banks pulling back on funding new loans, and then banks, as loans mature, and these are conventional loans, as they mature, these borrowers don't have anywhere to go but the private lending industry. So we're seeing a lot of that kind of deal flow coming through our door. Loan servicing, again, this is something that we really focus on maintaining a very high level focus on making sure that we're getting those payments in. Loans are remaining current. Right now, as of yesterday, we have 56 loans in the portfolio, totaling almost 44 million. So that's the highest level we've ever had. So 43.7 million in the portfolio. Average loan size at 780. Very important. As our fund grows, we can target larger loans. Very important again, because as you target larger loans, you're having less and less competition at those higher dollar amounts. You can imagine, as you're kind of in that 250 to 500 mark, you're really competing with the trusted investor and trusted broker. They can aggregate that amount of capital to do those loans. But when you get north of $1 million, it's really hard to aggregate a number of investors or even one investor to do that one loan. And so, we're just now competing with other mortgage funds. As soon as you get beyond that 5 million mark, now you're starting to compete with some institutional hard money lenders. But our focus is that 1 million to 5 million window. Average loan to value, we're getting it back down. Big push to get that as close to 65% loan to value. So we're a little higher than we want, but look, we're in a good range there. Weighted average coupon of the loans. So these are all the weighted average coupon, the average rate the mortgage fund is receiving after we take out that 1% servicing fee. So we're at 8.884%, 8.89%. And we'll continue to see that go up as these older loans that have lower rates are burning off, paying off, or we are extending the loans and we're raising those interest rates being charged to the borrower. So we continue to see that weighted average coupon go up. Interest income or the expected. So this is the expected interest income for this month will be over 320,000. So last month we were at 260,000. Just goes to show you how fast we're growing the fund, how much deployable capital we have. We should be over 320,000. Average term duration of the portfolio is 14 months. Again, keeping it short term. So, and no loans in default. Always want to highlight a success story. In this case, this was a $740,000 fix and flip loan that we had funded. First trust deed, the rate was 8.75%. Now this is on the lower rate side. Again, this one was funded sometime in the July-August timeframe, so rates were still kind of low at that point. 12-month loan, sold the property at 70, and our loan was at 70% loan to value. Now, what's really interesting about this one, we were within $1,000 of the underwrite. So we underwrite to future value on these fix and flip loans. So once the renovations are complete, what is the value of that property going to be? And we nailed it within $1,000. I typically take out the team for a little dinner if we get within a couple percentage points. So they got a big dinner. So let's take a look at the video, the before and after photos of this project. All right, so yeah, they did a great job of taking an older house and revamping it and getting it back on the market and sold. We're seeing a lot of this kind of product. The other thing we're seeing a lot of right now are ADUs, accessory dwelling units. Accessory dwelling units are simply, imagine granny flats. So single family house, somebody decides to build on maybe a secondary bed or another bedroom attached to the house or even detached to the house. Those that are detached may have full kitchens, and people can rent these properties out. And it's a great cash flow for somebody who may live in the front unit or the primary part unit and then renting out that accessory dwelling unit. I heard a lot of success stories recently about people that are making some really good cash flow on these ADUs. City of San Diego and a lot of other cities within California are really pushing these idea of ADUs, building ADUs, because they need housing in these cities. And this is one way they think they can accomplish getting housing. The only hurdle on accessory dwelling units, ADUs, is the fact that it takes so long to permit. I mean, in San Diego, you're still looking at a minimum 6 months to permit an ADU. We need to solve that problem if we're going to solve the housing problem here in San Diego. All right, let's look at our loan portfolio. Again, it's pretty, the largest loan type right now is our bridge loan. Again, those loans are just based upon current value, usually around 12 to 18 months. Borrower needs assistance in either closing on a purchase of a property or refinancing an existing loan. There's no construction component to it. There's no added value to it. It's just based upon current value. That still makes up the majority of our portfolio. They're good loans. Typically, they're on the portfolio a little longer, so we're not having to churn through bridge loans as quick as maybe fix and flip loans, where the borrower's in and out of that loan within maybe 3 to 5 months. Fix and flip loans, exactly the opposite. Borrower intends to update the property, add value. Usually there's a construction component to it in terms of we hold back funds for the construction or the renovation of the property. Not to be confused with new construction loans. We consider new construction as exactly that, new house on the property where you're dropping in the foundation, you're putting up the framing and finishing out a new house. And we're not really doing those kinds of loans right now. Don't need to. And they're really difficult to manage. You got to really have a good team to manage construction loans. So our focus is light renovation, fix and flip loans, and your bridge loans. Loan portfolio by type. SFRs, again, predominantly the biggest product that we're lending on right now. Multifamily, we're seeing some more multifamily loans coming into the portfolio. Commercial, now a lot of people say, well, they get worried about commercial because they're thinking office. Well, this doesn't designate office. I think a couple of these loans, one is a restaurant. We've got some industrial properties I show you there. I think we've got a parking lot on one. So it doesn't necessarily mean office. All right, so let's talk the mortgage fund. So average capital, and this was, when I say average capital, this is for the average capital that we had in the fund in March. So you can tell we've been able to bring a lot more capital into the fund, being that we're at 43 million, but this was the average amount of capital in the fund in March. Net interest income, as I mentioned, is a little over 240,000 that we paid out to investors just last month. Again, that is the most we've ever paid out in the fund, but we're going to blow that away here in April. Yield for February annualized was 9.72%. But again, here in March, we were down to 8.7%, and that's more of how we calculate returns. It isn't that the return or the average coupon rate of the portfolio dropped. It's just that February had 28 days. Right now, our year-to-date, I did not update this, but our year-to-date return, I think, is about 9.1%. So we're having a good year this year. And then a 12-month trailing average, that number, unfortunately, I didn't update that, but you're closer to about 8.15% now. That number is going to go up tremendously because we're still taking into consideration months where the portfolio was still an average of an 8.25%. So you're going to see this 12-month trailing average number go up significantly. All right, total capital in the fund right now is at 40.4 million, with another about 2.5 million that has been pledged and is being processed and coming into the fund. Total of 144 accounts. As I mentioned earlier, we had raised a little over 3 million in March. We're tracking probably a little higher than that here in April. What's really interesting, again, what I'm finding a lot of new investor capital coming from are word of mouth. So we're doing a lot of marketing, trying to bring new investors in, but I just want to say thank you for all those that had mentioned to TaliMar Financial. We're having a lot of great meetings, a lot of discussions, phone calls with new investors that have been referred over to us. So thank you very much for those referrals. Okay, investor returns. So this kind of goes to show you, and this graph doesn't do a great job of showing you the discrepancy or the difference in returns, the jumps, but you're looking at March 2022, you're just slightly over 7%. So now you're starting to see from 7% jumped all the way up into February of 9.7. But we're really going to be in about that 9% range, 8.75, 9%. Now, if the Fed comes back and raises the Fed funds rate another quarter point, we're probably going to see another increase in investor returns as we charge more for our money to borrowers. Okay, assets under management. So many of you know that we got our start doing trust deed investments. For those that are not familiar with trust deed investments, that simply means that we were placing individual loans with individual investors. The fund is different. It's you pool your investor capital in, and that fund is what holds all of the loans. So your money is diversified over a large portfolio of loans versus just one trust deed. So about 10 months ago, we stopped offering individual trustees and just had all that investor capital moved into the mortgage fund. In fact, we bought a lot of investors who wanted to invest in the fund out of their individual trustees. If you're interested in selling your interest in the trust deed and moving your investment into the mortgage fund, please reach out to me. I'd be more than happy to talk to you about what options you have about your individual interest. So the individual trust deeds that we're managing, we manage approximately 54.5 million in total loans. Of that, about 9.8 million is individual trust deeds, and those are burning off pretty quickly. So our goal is to be at 0 trust deeds that we're servicing, individual trust deeds servicing by year end, and all that money, or a majority of that money, gets moved into the mortgage fund. All right, market update. So there's a lot to talk about. A lot has changed. A lot has occurred in the last 30 days. Let's talk bank failures. All right, bank failures have been a good thing for the private lending industry. It's done a couple of things. Number one, banks need liquidity on their balance sheet. Even if they don't need liquidity, they're going to add more liquidity. Everybody is looking at bank balance sheets and they want to see liquidity. What does that mean? They're going to do fewer loans, and they want to get that money back out of the loans that they have done. So any loans that are maturing, they're not extending those loans. Those borrowers have very few options. Where are they going? They're going to the private lending industry to get their financing. That's why we're seeing a lot of loans from very bankable borrowers. I mean, I almost do a head scratcher on some of these loans and say, look, why are you not going conventional on this loan request? And they just don't have an option. So bank failures have been good for the industry, probably not so good for our borrowers, but look, we're gonna capture this opportunity, and I'm excited about it. I expect the Fed to raise rates another quarter point in May. I just don't think the next bullet point talked about how we dropped below 5% on inflation. Obviously, you can argue about how they're calculating inflation, but I think you are seeing it. I think generally what I look at when I'm looking at inflation, number one is I'm looking at gas prices. Where are gas prices? They've really stabilized. I'm looking at unemployment numbers. Now, unemployment numbers haven't, and that's the fourth bullet point, haven't really changed. I mean, we're still at 3.5%, and we're probably sub 3% here in San Diego. And I know there's a lot of noise in the market. I know, you talk about Facebook, Google, some of these big tech companies and finance companies have had some pretty big layoffs, but it's infinitesimal compared to the number of employees that they actually have and how many employees they've actually picked up over the last 2 years, especially during COVID. So you just don't see it in the numbers right now. That's why I don't think the Fed is going to be raising rates any higher. And I think, honestly, if we see the trend that we're seeing right now, I don't expect the Fed to be raising rates anymore after this quarter point raise. Obviously, there is a lot of pressure on banks right now. Every time the Fed raises rates, kind of puts banks in a difficult in a tough position. So they've got to consider that. So as I mentioned, U.S. inflation rate dropped below 5%. So we're seeing inflation get under control. Unemployment remains at below 3.5%. So as long as people are making money, they can continue to pay their bills. They're looking to buy homes. I am comfortable with the economy. California home prices. This is a head scratcher here. Obviously we saw rates jump significantly since May of 2022, and you saw a very big decline in the number of transactions, but it's rocketed right back. So buyers are okay with interest rates. There's a lack of supply of housing out there, and if someone does bring the house to the market, it's getting multiple offers again. So median sales price was at $743,200. Now I say it's a negative 7.8% year over year drop, but it's hard to say like generally home prices have dropped because if you look at here, the number of transactions that occurred dropped by 33% as well. So there's a lot of other components that go into sales price, and I'm going to show you a graph here on the next slide that shows exactly what home prices are doing generally in the state of California, and that's coming back. Days on market are at 37. Look, healthy market is 45 days. So we're still below 45 days. And even in today's market, still blows me away. If you're in San Diego, I bet you that's sub 30 now, if not even more or fewer days on market. All right, let's talk housing market. I wanted to highlight this graph so people could visually see what's going on. What you have right here is about February 2022 when home prices peaked. And this is for all of the state of California. And this is where home prices really peaked. And as rates, right about here is when rates started to increase. And you saw transaction volume going down. Hence, you saw the average price point of homes being sold also started going down. But what do you see right here? This is right about that January timeframe. That's when people started coming back into the market, okay with interest rates, and that's when you saw that average home price jump back up. And it actually jumped up pretty significantly. So just generally, you're at 700, and here you're at 740 within a quarter. That's a pretty drastic jump. And it's interesting that the media doesn't really talk about this. They're focused on some other noise out there, but I just wanted to show this to you. All right, discussion points. As we talked about, banks continue to pull back on lending with focus on liquidity. This is why it's such an amazing opportunity to be investing in the private debt market. The demand for your money hasn't been higher since 2010. If I could I could stand on every rooftop here and just yell it out. I haven't been as excited about the private debt market since, again, 2010. The opportunity is just so much opportunity out there to really increase what we're charging on our loans and getting those returns to our investors. Capital markets appear to have stabilized. So one of the trends going in, especially about the June timeframe of last year, was these big national hard money lenders literally stopped lending. The capital markets seized up. They could not sell their loans to the capital markets. So to take a step back, what happens is a lot of these national lenders, imagine like consumer mortgage companies, they close loans and then package them up in securities and sell them off to the capital markets. Well, the capital markets wanted nothing to do with the private debt market. They felt it was too risky. They didn't know where values were going. They didn't know, what the trends were. But the capital markets have recognized that, we're not going into a recession, or if we had, or we may have already gotten out of the recession. They're confident about the market. They're seeing unemployment levels remain low. So they're out there buying this debt. What does that mean for us? Well, it's a little added pressure. That's definitely some of the other lenders that are competing with us right now, especially in the San Diego marketplace. So if the capital markets are strong, that means we've got some more competition. Private money lenders are moving to a mortgage fund model. This is interesting. So I was at the Jurassic Innovate 2023 conference, Jurassic being one of the big law firms that services mid-market fund managers like me. It's a big conference for us to get together and talk about trends, meet with vendors and whatnot. And it was pretty apparent that not everybody, but a lot of hard money lenders that have traditionally either sold off their loans to the capital markets or sold them off to individual investors are moving to a mortgage fund model. And there's a couple of reasons why. Number one, it's very easy now, much easier to start a mortgage fund. Number two, it's a much more efficient platform for fund managers like myself to manage a business of loans. And then number three, obviously, there's the tax advantages of having a mortgage fund. And then four, you're able to scale the business a little easier than trying to sell off individual loans. And then the fifth point that I wanted to talk about was, and it isn't so much right now, but when the capital markets stopped buying these loans, a lot of these national lenders had nowhere to go with the loans. Either these are loans that they funded but were kept on their portfolio. They couldn't sell them. They couldn't go anywhere with them. So what would normally happen for these national lenders is they would close the loan, sell that loan off, make their profit, recapitalize themselves, and go do more loans. Well, if they can't sell those loans, they can't do new loans because they can't recapitalize themselves. So in an effort to try to counter that, they said, okay, well, let's just raise money in a mortgage fund, and instead of selling those loans off to the capital markets, we'll just put them in the mortgage fund, recapitalize ourselves in that way. So mortgage fund models are becoming extremely popular. Credit lines. So credit lines are getting expensive. As many of you know, we have a $5 million credit line with Endeavor Bank. And it's a great way to balance cash flow. So as cash goes in, cash goes out, you're constantly needing to balance that cash flow. So you never want to have too much cash sitting on the balance sheet because it doesn't earn any income. So you want to make sure to get all the cash you have on the balance sheet is out the door invested in mortgages. But what happens if you don't have enough money to fund the next loan that comes in the door? You're going to draw from a line of credit, fund that loan, and then pay that line of credit down as new investor capital comes in, or when you have payoffs of loans. And so that allows me to balance the inflow and outflow of capital. But the problem becomes is it gets more expensive. Every time the Fed raises its rate, what the bank charges me for that credit line gets more expensive, which means I have to charge more for the loans that we're doing. At the end of the day, it's better for you as the investor because it's forcing me to charge more for the loans that I do, which increases the return that you're going to receive as the investor. The sixth point is the TaliMar Investor Portal. Okay, I want to take a moment. I'm going to go ahead and share a separate video here. I'll probably splice it in talking about the Investor Portal, how you should be logging in and taking a look at your account. And this is the TaliMar Financial Portal. The login, and you can look at all the statistics of the fund. So I'm going to cut in a video here and I'll show that to you. All right, I wanted to highlight this article, and I was jumping up and down when I saw this. I saw it on my phone on the Bloomberg on Bloomberg News, and what they're talking about here is the shadow lenders are moving in and filling the void left by banks, especially banks that are not lending right now. So obviously people need to do transactions and they need to borrow money from somewhere, but if banks aren't lending, where are they going to go? Well, they classified us as shadow lenders. Okay, I like to use the term private money lenders, but they can use us shadow lenders. In fact, I had an investor call me up as a joke and asked me if I was the shadow king now. But it was a great article. It really goes into kind of the opportunity in the private debt market, why we're really able to get some really solid returns and keep our loan to value ratio down. So great, Mark. If you get a chance, or if you're interested in getting a link, just let me know and I'll send you the link on this article. All right, Jurassic 2023 conference. This was last week. I was a featured panelist to talk about the life cycle of a mortgage fund. I shared the stage with two very accomplished fund managers, one from Arixa and one from Socotra, and just really talked about kind of what the health and what the fund industry was looking like. And they brought me on simply to talk about being on the smaller end of or having a fund that was put together in the last 2 years, about the hurdles that I've faced in launching my fund. And then honestly, it's tough because we haven't had too many hurdles per se in the fund, but it has definitely been from a business perspective, a change in how we focus on originating loans, how we build upon the business, and how we do our investor raise. So I gave some tips on, for others that were in the audience about, if you're interested in launching a fund, these are things that you should consider. So it was a great opportunity to speak to the crowd. And then you got a chance to meet with some of the other fund managers, and then those at the Jurassic LLP, our firm that put together our mortgage fund. All right, upcoming events. We are booked solid. So I'm going to be speaking on another panel here for AAPL. This is on the left side here as the Fund Manager Forum. AAPL is the American Association of Private Lenders. Again, it's similar to the Jurassic conference where a lot of fund managers come together, trade notes, talk about the industry. And it's a really good conference for fund managers. So I'll be speaking on a panel there. On the 27th, I'm going to be hosting a webinar, an educational webinar about the strategies I use to invest in the private debt market. This is for people that are interested in investing in the mortgage fund, but also for people that just are investing in trust deeds and want a kind of maybe be educated on how I look to invest in trust deeds. And so if you're interested, I'll go ahead and also post a link to the webinar so you can sign up. That's on April 27th. And then we have the National Lending Expert Conference coming up, Lending Experts Conference. And similar, again, another fund manager conference This is more, I would say, of a educational conference. They bring a lot of people in to educate us on kind of what's going on, again, in the industry, a lot of legalities and accounting changes and whatnot. So that's an opportunity to go to that conference. What's nice about that one is it's here in San Diego, so I don't have to travel. All right, common questions I'm getting still. Number one, K1s. You can go on the Verivest portal to access your K1. I know it's confusing. We have two portals. One is the TaliMar Financial portal. The TaliMar Financial portal is kind of where we show all the dynamics and statistics on the fund, on the mortgage fund. You also can see some of your account information. Verivest is the fund administrator. They're the ones that do all the accounting for us, and they do all of your statements, year-end statements, and K1s as well. So you can go in there to get your statements and look at some of the other information on the fund. 1099s, if you're investing in trust deeds, you should already have those. If you don't, contact FCI. I can give you their phone number, and you can get that 1099 from them. Retirement funds, we're seeing a lot of self-directed IRA capital coming in. If you want to use retirement funds to invest in the mortgage fund, feel free to contact me. If you don't have a custodian to do that, we can introduce you to some of our preferred custodians. I also have some other great news that we are in the process of getting approved for the TD Ameritrade and Charles Schwab platform. So if you are currently, if you use them as a custodian for your retirement or non-retirement accounts, if they're your brokerage, you can actually invest in our fund directly on their platform. So we're going to be finishing up our audit for 2021 and 2022 at the end of this month. We just have to submit that audit to them, and then we're going to get the thumbs up, and we'll go ahead and notify everybody about the fact that now you can invest your brokerage funds and not have to go through a custodian for the mortgage fund. Again, if you've got questions about that, contact me. We're more than happy to talk to you about it. As I mentioned, get a lot of questions out. There is no income cap on the 20% tax deduction. So all the income that's generated out of the REIT from our fund goes to you. And no matter your income, you qualify for that 20% tax deduction. That's because we have a REIT, Real Estate Investment Trust. So we get a lot of calls from accountants saying, hey, Brock, I don't think you're right. Or that's not the case because I have a client that makes over a certain dollar amount. So I just share them the information from the IRS website, demonstrate to that everybody qualifies for that 20% tax deduction. Minimum reinvestment is $1,000. We still have that minimum reinvestment. We have a lot of investors that may be invested in other mortgage funds or trustees, and either getting income or getting payments into their account, and they want to just get that money out and reinvest it. Feel free to contact me. We can get your kind of that money that's being deposited into your account reinvested for you in the fund. Just a quick reminder, we have no lockup period in the mortgage fund. So if you go day one, you don't feel comfortable day two, we can get your money back out. We ask that you don't do it, but look, we have waived the lockup period. We are what I call semi-liquid, so we can get money back out the door pretty quickly. All right, so let's get to promotions. I know a lot of people like that $1,000 promotion that we were running. It was very successful, but I think we've got enough momentum in our capital raise that we don't need to be doing the promotions right now. But we do have a promotion. If you do refer somebody and they do set up an account, that doesn't mean they invest in any way. Just set up an account with us. You'll get a $250 gift card. So please refer any investors, family members, or whatnot. We have available space in the mortgage fund for them. And make sure that when they do request information on the mortgage fund, they put your name on that request so that we can tag you for that referral. With that does it for my upmarket update. Like I said, I'm very excited about where the industry is headed right now. There's a tremendous amount of opportunity out there in the private debt space, especially as rates go up and banks become very, very conservative on their lending and try to focus on put liquidity on their balance sheet. Our balance sheet is very solid. We have no late payments and we have no defaults, so everything is performing on the portfolio. And with that, if you've got any questions, feel free to reach out to me. I love chatting about real estate. I love chatting about the mortgage fund. I love chatting about trust deeds. I just love chatting about it. So give me a call. I've got my contact information on the screen, or you can go ahead and email me. Or best of all, you can go on our website under the Investor tab and ask for the executive summary. So I want to say thank you for listening. Thank you for those that have invested in the mortgage fund. And thank you for those that are considering an investment in the mortgage fund. Look forward to chatting with you next month. Talk to you about all the great things that have happened in the fund.